What what advice can you share with people, Mark, about 2021 and sheltering themselves from the tax winds that are swirling around us?
All great questions, and lots of them, Andrew, as normal. Let's try and break that down a little bit. I'm going to make the assumption that people have done a lot of the work to get their 2019-20 tax returns done. If you haven't, pull your finger out. You haven't got long left. You don't want to be paying £150 per return penalty for not doing that. So get that done. I was saying, I think it was back in sort of May, June, we recorded a video together, and I was telling people to do it then, because of course, if you haven't done your tax returns, you don't know how bad this Section 24 is necessarily starting to bite you. So I think a lot of people took that advice because we were busier this summer than we've ever been. And I understand that part of that's due to people sitting at home bored, on lockdown, on furlough, or whatever it might be.
I mean, it's no doubt a really interesting, unique time. And we were just chatting earlier, just before we started recording, about our events and how that's completely changed. Is it ever going to be the same again? And I think some things, they were going to happen eventually anyway, and this whole thing has just accelerated everything. So, you know, the technology was been there for a very long time for people to work remotely, but the appetite wasn't necessarily there. And now people have got comfortable working from home in their pajamas and stuff. They don't necessarily want to go out to work. So I think definitely certain things are going to change that would have happened anyway. And now this is just kind of accelerated that whole process. And we just have to be ready to adapt. So I've been involved in property about 15 years. And one thing I learned quite earlier on is that the only certainty is constant change. And I think when you listen to some of David's content, you certainly realize that, you know, he's been through a lot. You see things are constantly changing and evolving, and you can't make 10, 20-year plans like the way you could have before in property, because things like taxation, Brexit, all these things will completely change the market. So we've been very big and focused on professional house shares, HMOs. That's been a big core part of the business, and also doing some flips. Although I really enjoy doing the flips, the biggest challenge has been the market's been too hot, prices are too high. You can't buy something and really add enough value to be able to sell for a profit. So it's just been a few of those, and recently starting to do some new build, which I find is another way to replace the flips. It means you can build the value as opposed to buying something where you're going to add it in.
Let's have a look at reserves, Kwasi. I mean, are you, by selling some and relocating to other areas, you've intimated it might be London you're selling and move into the Midlands. Is that to reduce gearing? Is it to increase cash reserves? Or is it just to get better yields or better capital growth? What's the reasoning behind that?
So one of the things, like, you lock in your yield when you buy. So I'm really lucky. I've got some really good yields from some of the properties I've bought in the last sort of 6 years or so. But also, if you want to sell in future, the yield is important. So, you know, in London, we had some great growth. I know that for anybody buying any of my properties right now, they're probably getting half the yield I got when I bought them. And so in the future, you know, if you look at that cap rate, it's going to make it more difficult to sell.
Yes.
And so that's something that plays on my mind. Not just, people often think about their own yield, what they're getting, etc. But if I look at the exit strategy, I need to be able to sell it to an investor probably.
First of all, I think in terms of property, you've got to look at what property is and how it behaves in terms of an asset. And when we talk about property, it's a vast array of different things. So we were talking about real estate. You can have commercial real estate. Within commercial, there's various different asset classes. You've got house prices, rental prices, all these different things. So the first thing I guess is to work out what in particular you're talking about. So if we were to take something that most people kind of understand, the idea of house prices, you look at how that behaves compared to maybe some other asset classes. And this is where I think people kind of can often get mixed up, because there are some odd reporting or views that come from a lot of the, should I say, higher value kind of asset managers when they talk about house prices. So what I've looked at is how house prices behave compared to some of these other assets. And when we're talking about assets, you can talk about cash, can be equities, can be commodities, gold, etc.
So let's look a bit further forward, a bit ahead now at 2021 and stick with, for now, the property market. Which way do you see it headed?
Well, get the crystal ball out. First of all, nobody knows. Of course, nobody knows, because nobody knows what the future holds. And so people can talk with varying degrees of confidence of what's going to happen. I'm fairly confident, personally, that this stamp duty holiday will have a major influence on the property market in 21. Huge influence. And although some people are muting the idea that they might extend it, I can't for the life of me think of a reason why they would do that. I don't think it would increase any more stimulus. I think it would just give away a lot of tax revenues that they're likely to get, because so many people are going to miss the deadline. So I personally think I'll stick to the 31st of March. And what we might see is the final flurries of the stimulus occurring in the early part of next year.
I think it will be challenging. I think the can's been kicked down the road a few times this year, and I've discussed some of that with David some months ago. And I think there'll probably be a continuation of that can being kicked down the road until there's any sort of major shift in the credit rating of the UK or anything else similar, because there's a lot of us have got that feeling that, you know, the taxation, you know, they're going to ring the bell, they're going to start getting the monies in. But of course, esteemed economists like ourselves understand that to start ramping up taxation at this point when the economy is so fragile is actually the opposite of what you want to do, really. And as unpopular as it would be, you're better off cutting tax. Now, they haven't had much pushback to cutting the VAT in the leisure and hospitality sector, even though it's very expensive. And it's strange when you think about it, how few headlines there are about that. Basically none, despite the cost of it. Whereas the headlines about the furlough scheme, for example, are thick and fast, even though a lot of people who were furloughed would otherwise have been made redundant, and there would have been a similar amount of benefits being claimed.
2020 is a very good, really good example of stuff happens, okay? And you have to be able to adjust. And while it's that time of year and it's sort of fun to predict, we're crap at predicting. If someone was really good at it, they wouldn't be listening to us. They would be doing lots of other things because they'd be super wealthy and all the rest. What I think is true is that you should look back and you should think about and what might happen in sort of scenarios and be nimble, intellectually nimble, business nimble, economically nimble, that you may have to adjust, you may have to change direction, you may have to deal with things that no one's seen before. It's rare to see a pandemic. There's very few people that are alive that could have even seen one.
So, John, it's been an interesting year. One of the key themes that we focused on last year was Brexit. Mm-hmm. Where do you think that's going? Do you think that will affect the property market, or do you think it's a non-starter for property for 2021? Bearing in mind, we haven't actually got, it's December and we don't actually know where we're jettisoned to on the 1st of January.
At the time of recording.
Correct. Yes, yes. And David's right, it could change 20 minutes from now.
Yeah.
So it's going to be disruptive whether we have a deal or not. It has to be, because if you think about it, if you voted to leave, you want enough change so that you feel the future is better. If you voted to stay, you didn't get that. You're going to get hit by changes that you didn't want, but they're going to happen. Question is, we don't know what changes.
First of all, I would say, putting it into football terms, it's not going to be a game of two halves. I think it's going to be a game of 3/3. And the first third is going to be, for a lot of people, surviving, just getting through until Easter. And from what we know so far, the vaccines being effective and increasingly rolled out. There was some PR at the weekend through the Telegraph that 27th, 28th of
Let's just run through the year really and chat about some of the calendar and the key milestones, or millstones as they could be, for property investors, which really depend a lot on the economic backdrop that we all face.
Absolutely.
So what do you see? Let's take it quarter by quarter. What's in store for the first quarter of 2021?
Well, for me, the way I look at it is there's two sides to this, and I'd like to look at the optimistic side, but the optimistic side is for those who capitalise on the opportunities. So if you're an existing commercial property owner, it might not be a good year of news for you. So 31st December, we generally see lots of retail outlets typically going into administration because their trading year or their Christmas hasn't been brilliant. Now, 2020 hasn't been a great year for retail. So I expect to see a little bit of an offloading of more of those businesses that have really struggled to compete with Amazon and other online retailers.
That's a very good point, because every year, I mean, of course, December is a massive Christmas trading period is massive for many retail stores. And with COVID and tier 3 lockdown and all this sort of stuff, they've been hammered. So normally what we see is zombie businesses just given that final death knell.
People know that what myself and business partner do is we buy and sell through auction. That's our thing. And we haven't even been able to, we've got nowhere near close to what we think something is worth. I don't see that improving in the first quarter or even the first half of 2021. I think the first quarter is going to be driven by, the same lunacy that is always driven by stamp duty changes or stamp duty holidays. People are going to be going hammer and tongs, probably overpaying to save themselves, overpaying 20 grand to save 5, which is just, it boggles the mind, but you see it every single time, the last 10 years especially.
But David, let's have a look at 2021. What does it look like for property investors?
Well, I think it's a mixture, isn't it, of opportunity and crisis, and the two always go in hand to hand. As you know, Andrew, a particular thing of mine is the property cycle, which I've studied for many years, and I was coming into my third, I guess, property cycle now, each one of which takes some 18 years. So I was feeling pretty complacent about everything and felt that I really kind of understood the dynamic of it all, having gone through George Soros and all that kind of thing in about 1990, having gone through the credit crunch in 2007. And I thought, okay, it's all coming around again. And then what we've seen in 2020, and this obviously impacts 21, is we've seen something that normally takes 18 years compressed into about 9 months. And do you think 21 will be a bit easier, perhaps?
I think so. I mean, just touching back on 2020, one of the things that I was quite impressed about, I often will black box situations and look at what we could have done differently, how we might have improved things. And I felt that the business held strong because of policies and ways of working that I'd adapted and built up over my over 20 years in property. Things like a repair and maintenance reserve, never, always having a couple of months mortgage payments in reserve. Things like that, strong accounting systems that could follow what was happening. We also report to Experian, credit agencies.
So here we are at the cusp of a new year with a vaccine being rolled out and people getting their doses now, and with immunity, I guess, building up, not just in this country but around the world. And so in 2021, things are going to ease up a bit, quite a lot perhaps. How do you see things panning out? Let's start in the first half of 21. How do you see it all?
How do I see it all begin? I mean, well, first of all, no one knows for sure, but the only thing you can really do is sort of go back to, I'm a great believer that sort of history kind of repeats itself. And the nearest that I've got to this, I think, was sort of 2007, 2008, which was the financial crisis, albeit different in its makeup. 2007, 2008 was more of a liquidity issue for the banks, and it was just sort of contained to the banking sector. Obviously, that has knock-on effects to us as property investors. This one, it's completely different. It's not wiped out, that's probably the wrong expression. It's impacted virtually every area of life. But if you go back and look at the impact of the 2007, 2008, and you look at when, from a property perspective, because this is what we're talking about, when that impact really took hold, it wasn't until about 18 months after